Okay, so Shaun,
Justin.
welcome to
Yes.
our conversation. So we're going to tackle the topic of due diligence today.
Yes.
So just a brief explainer, due diligence, you know what it is. Let me put it in some plain language to start off with. So typically when somebody is selling a company for the first time or second time or third time, a buyer is examining the company to look for faults. And the way that I try and explain that to my clients, because often they've never done this before, is they've usually sold a house. They know the process of selling a house. And of course, when you sell a house, the buyer will put a surveyor to come in and have a good look around and look for faults, right?
Yep, exactly.
So that's the process. Of course, it's fairly unobtrusive, takes half a day. And at the end of it, the surveyor says, yes, there's faults. And if there is, so happy be. If there isn't, no problem. So it's exactly the same process that a buyer sends a team of experts into a company to examine the business and look in a lot of detail to saying, are there any faults?
Yeah.
Of course, it's slightly more intrusive.
In depth, definitely. I think it's the one part of the M&A process that people probably underestimate in terms of the amount of time it takes. I think that's certainly what we find in terms of feedback at the end, was that the due diligence process is, it's intrusive. A buyer is looking to make sure that they are acquiring what they think they're acquiring, and identifying any potential issues they either need sorted pre-completion or things that they probably need to then feed into their sort of 100-day plan or whatever their plan is post-completion. So no, it is certainly a lengthy process that a lot of sellers underestimate the amount of time involved.
So instead of, in a house buyer analogy, the surveyor coming in, when it's due diligence for a company, then we've got usually three teams coming in, haven't we?
Yeah.
So we've got the legal due diligence, so that's the lawyers having a look at the company and all the legals inside the business.
Yep.
Then we've got the financial due diligence, and that's the accountants all going in to check the numbers. And then we've got the tax due diligence, looking at tax affairs.
Yep.
So of course is that most company owners probably have never had their business examined in the level of depth ever before.
I think that's the thing. When you're running a business, you're not looking at it from all of those specific angles. You're running the business. You're doing what you need to do in order for the business to operate, and you're doing what you need to do and you're aware of in terms of legal compliance and various regulatory compliance aspects. But as soon as somebody starts asking you those probing questions, sometimes you start to go, okay, yes, I've got that in place, but actually does it do what it needs to do? And I think we're certainly finding more and more that people are going down the route of trying to front load that due diligence process, not just because it's time consuming, but I think also because it allows people to try and identify issues before a buyer does. And I think there's a number of advantages and disadvantages for doing a sort of pre-sale due diligence exercise.
Yeah.
Time saving is the main one, I think, in terms of your management team. When you are starting with a transaction, usually it is not well known within the company, so you don't have your entire team available to help you with the due diligence exercise. Normally it's a seller, maybe some key members of the management team, and so actually you've got to continue to run the business whilst doing this exercise as well. And I think it's quite difficult for people to manage that. And so actually, if you do a pre-sale due diligence exercise, it allows you to front load some of that time. But I think in terms of identifying potential issues, they're sometimes easier to sort pre-sale and pre-going to market than they are when you're in the midst of a transaction.
Yeah, and that's my experience. My experience is that, so one is that due diligence is intensive.
Yep.
So typically, my clients will receive a due diligence sort of questionnaire. There'll be a bit of shock horror that goes on behind the scenes at the number of questions and the depth of the questions. And of course, so there's a realization that it's extensive. It's an extensive sort of piece of analysis that teams of people are going to do. The second part of it is due diligence is expensive. It's expensive for the buyer and it's expensive for the seller. So at the time you've struck heads of terms, you've agreed a deal with a buyer-seller, enter the due diligence, then the seller is having to pay lawyers, tax advisors, accountants money to support the process, and the buyer is doing the same. So money is getting burnt quite rapidly, and it can feel quite painful if the buyer finds, I'm going to call it a skeleton in the closet.
Yeah.
Now, we deal with all different types of companies, manufacturing companies, distribution companies, e-commerce business, a wide range, right? But there are some typical things that float to the top that are what I would call the skeletons in the closet.
Yeah.
And these are the things that, because of course, if I go back a step, due diligence is to try and find faults, but occasionally there is a major fault line. These are the skeletons which actually can stop a deal.
Yeah, make or break a deal.
Make or break a deal.
Definitely.
So let's have a conversation, because the first one that comes to mind, and it's a one that you and I have often sort of crossed the bridge on, and that's the share register.
Yeah.
Most business owners give zero focus on the share register. Yeah. You know, they start their business 30 years ago, they run the company, 30-year elapses, and they go, we're going to go sell it. You ask the question, is the share registered okay? Of course, there's a question mark to think, where is it?
Yeah, I think I was going to say 50% of the time people don't even know either what it is or where it is.
Yeah.
And then even when they do, sometimes it's out of date, it's not up to date. And I think it's really important that is, I think what people need to realise is that is what a buyer is purchasing. They're purchasing the shares. Everything else in the due diligence exercise is really important, but actually the asset that somebody is buying is the shares in the company. Mm. And so if your share register is not an API order and you haven't done your historic share transactions legally in a legal compliant way, you then potentially have a major issue. And like you say, I think that is probably the biggest aspect of a due diligence exercise that can make or break a transaction. Yeah. Certainly share registers, working out where your register of applications, allotments, transfers, members is in the first instance is important, but two, making sure that it's up to date, because it's one of the things that a buyer will really, really focus on.
Yeah, and there are some critical, I'm not the lawyer in the room, so I have to stress that you're the lawyer, I'm not.
Yeah.
But there are some critical share transactions that really are game changers, aren't there? So company buybacks.
Share buybacks and capital reductions are the ones that lawyers in specific will hone in on. Yeah. The main reason for that is if you've undertaken a share buyback incorrectly and not in compliance with the Companies Act, it's potentially void, which means that the shares remain with the person who you purportedly bought them back from. That can be a real problem, because unless that person is a friendly face or somebody that's still involved in this process, it involves quite an awkward conversation going back and trying to rectify that. And sometimes in extreme circumstances, you need to go to the court and get a court order to almost rubber stamp and say, the share buyback has been completed, notwithstanding the procedural deficiencies. The share buyback has been completed, and it's certainly far easier, I find, if you can work out if you have any share capital problems before you go to market, or certainly before you've got a buyer who is looking at your share transactions and looking at your statutory books. I don't want to say it's far easier to sort out, but you're in control of that. I think as soon as a buyer becomes aware of a share capital problem, it is going to be resolved to their satisfaction as well as yours. Yeah. I think you have less control over exactly how you're going to do that. And I think also where a third party's involved, I think sellers sometimes feel slightly awkward, certainly where you then have to go back to somebody. Yeah. Against the backdrop of a transaction, I think people's biggest fear is they're going to be held to ransom, because somebody's now realising, there's a transaction in the offing. These guys need to sort this out. And I think that's certainly a seller's biggest fear when these sorts of things spring up halfway through a transaction.
And I think it's a realistic fear, because I've had that happen. We've had a number of transactions, and I'm thinking anonymously, where somebody thinks they own a company, and it turns out that when the share register is examined, is that, let's say, the company bought some shares from a third person that's now disappeared, and it was a sizable chunk, call it 25%. Yeah. They think that person's gone, they were paid a smaller amount because it happened a long time ago. Yeah. And suddenly the lawyer's saying, you've got to go to that person, and basically the share transaction didn't happen. Yeah. And you've got to do the paperwork now, today. Yeah. And, the reality is a seller is right to be concerned, because going back to that third party and saying, could you just sign 10 or 12 different pieces of paper here? The share transaction didn't happen. We're selling the company, by the way. Gosh, it's worth a lot of money now. Of course, what do you think is going to happen? So there's a risk, right? There's a risk that individual goes, gosh, well, actually, I'd like my slice of that now. So that's one issue. So what we're pointing a little bit to, due diligence is a long process. We'll cover that off in a minute. But there are some aspects of due diligence that if you were to advise a seller, you'd say there are certain aspects you want to get examined before you go to market.
Yeah.
You do not want this to happen real time, live in a transaction. This can stop it or delay it severely.
I think that's the point. When at heads of term stage, most people will agree a timetable. And as soon as we've agreed the timetable, hopefully people are fairly focused on achieving that. You then come across a problem. People don't really want that timetable to slip. And so actually the way in which you rectify the problems that have been identified might be the most efficient way, or that the buyer is reasonably comfortable with. They might still want indemnity coverage, even if you do go about it, rectifying a problem mid-transaction. But it might not always be the best way, because sometimes the best way will take weeks or months, and people feel that the transaction can't afford that sort of time slip. So it's certainly easier if these things are identified early on to be able to go away and have those conversations. They're never easy conversations.
No, so that would be my recommendation. So
Definitely.
we'll pull it up and summarise it at the end. What's another type? I mean, I'm thinking about intellectual property, and the one that seems to come up for me time and time again, more and more businesses are using e-commerce.
Yep.
So they have a website, they're transacting using that website. It could be all of their business or some of their business. And when I ask my clients, do you own the intellectual property to these important assets? The answer is always yes, of course we do. We had it designed by an outside company.
We paid for it.
We paid for it.
Yeah.
And of course is that we know that sometimes that is not true. They don't own the intellectual property.
No, and I think that's the thing. Intellectual property is a slightly odd concept in a way that I think you're right. A lot of people go down the mistaken route of, well, I've paid somebody to perform a service, usually the building of a website or creation of content for a website. I've paid them in full. So that's the matter done. I now own that. Intellectual property arises in a specific way that it's owned by the creator unless it's specifically assigned. So when people enter into agreements with creative agencies or anybody who's pulling those sorts of things together for them, they're probably not looking at specific assignment provisions. And so again, that's something that needs to really be looked at. And if there isn't a specific assignment of intellectual property created by a third party, so essentially a non-employee, then there will need to be some form of actual assignment, a deed of assignment or otherwise, to make sure that the intellectual property is then held by the target company. A buyer will always want to know that. They don't want an unknown person owning any part of the intellectual property of the company.
Yes.
We've sort of seen that a number of times. Yeah. It's probably, in comparison to the shared register, it's usually an easier issue to get around, but you still have the point of, well, why now? Why have you suddenly identified this? Oh, well, it gets the backdrop of a transaction. Ultimately, if somebody owns that IP, again, you find yourself in a very similar position where you could be backed into a corner to make an additional payment for actually that IP to be assigned over. So it's certainly another problem area. I think another one we see more and more at the moment is data protection. Lots of quite broad brush indemnities and SPAs around data protection, and that's normally because a buyer may well identify data protection policy issues. They will say, actually, we've got policies we can put in place at completion, but that doesn't actually get you to a point where they're comfortable you were compliant pre-completion. And so the easiest answer for a buyer there is, well, provide us with indemnity coverage. Whereas actually, I think, again, if you look at your data protection requirements, because not everybody will have to, I think the issue when GDPR came in was it was quite a complex area. People didn't necessarily get completely under the bonnet of, actually, what do I do with personal data? What am I? Am I a controller? Am I a processor? What documents do I need? And so I think there's lots, certainly at SME level, there's lots of companies out there that are operating, not necessarily completely in breach of GDPR, but they certainly don't have the policies to back it up. And when that's identified during due diligence, it's certainly an area that a buyer will hone in on to make sure that they've got sufficient coverage for any pre-completion problems.
So I think we can probably summarise. I think we'd probably be on the same page if I'm thinking that anybody selling a company would be advised to take their business through a degree of due diligence before going to market. I know that when I speak to my clients, when I say you want to spend some money doing this, and the answer is invariably, gosh, well, there's no value in that. But there really is, because it can save a deal from failing. I think the statistics on the number of companies that come to market that do not sell are horrifying. It's allegedly somewhere around about 80% of companies don't sell. Well, there's a reason they're not selling, you know.
Yeah.
So a lot of it will be due to the fact that they failed due diligence. So the cost of that is just hugely expensive. And then when you factor management time. So let's talk about just the brief period of how long this due diligence takes. Brief was not the right word there, but it's a period, right?
Yeah, no, it's a period. It's a significant period. I think if you ever see we've seen many a transaction timeline. Due diligence takes up a good chunk of that.
How long typically?
It's really difficult to say because actually I think it depends on the size of the business. And you mentioned the sort of 3 core strands. We're seeing more and more now people going into sort of specific insurance due diligence or commercial due diligence on top of your legal, financial, tax, and they're really drilling into some of these aspects in a lot more detail than probably we've seen before. So I would say due diligence is a good month to 3 months, depending upon the size of the transaction, the size of the business, the complexities involved. But it's certainly not a quick, throw a few documents at the buyer and they'll be happy. It is very much, there's rounds to due diligence as well. You'll get an initial questionnaire, which will be sizable. It will be hundreds of questions. You hope that the next round of further due diligence, there'll be less questions and it gets less and less. But we've all been there where actually that due diligence exercise sometimes just feels like it goes on forever. But until the buyer's satisfied, they're not going to move forward to signing. And so unfortunately, it's a necessary evil as part of the transaction.
Yeah, and I think to just add something slightly tangential to that, and this is something that I would always counsel anybody selling a company. So most businesses might have used their local accountants over the years to produce the statutory accounts. There's a difference in capability in the type of advisor that a seller needs in the due diligence to take the business to an exit. And we see this all the time.
Yeah.
And what I'm pointing towards is that the local accountant, the 3-person accountant that's done the books for the past 10 years might not have the level of capability to answer, let's say, technical due diligence questions from one of the big 4 accounting firms in the UK.
Yeah.
And we see this time and time again. So sellers are loath to change their accounting team and spend more money, but I always counsel to saying you need, because there's 3 strands of due diligence, legal, tax, financial, and you need 3 specialist teams in your corner to help you get this deal over the line. So don't skimp on the monies, because if you're talking about, we deal with transactions from 5 million to what's the highest number? It's a big number, right? As a firm, you handle 300 million, 400, that kind of size. So, the relative cost is actually marginal compared to will the deal get over the line.
I think that's the thing, and I think in terms of the advisors, you need somebody in your corner who's fighting for you. You don't have the time to deal with every single aspect of that due diligence exercise. You will need somebody else to assist you with it, and so you need somebody that's competent. You need to have complete, comfort that the answers being provided by your team are correct and you're being led in the right direction. Like you say, lots of people have not gone through this before. The first time we meet a lot of people, it's the first time they're selling their business. They don't necessarily know the process. So to have an advisor who equally is maybe not as familiar with that process or doesn't necessarily have the ability to deal with the due diligence exercise, that can be fairly problematic. Again, from a cost, time, and just in terms of actually the length of that DD process, I think, is extended. If you're not giving sufficient answers to the questions, it just rumbles on and on and on. It's one of those things. It's getting the right people in your corner, definitely.
And we've seen that. We've seen that actually happen in practice.
Lots of times.
So let's summarise it. So due diligence. So it's legal, tax, financial. It's 3 months typically, 2 to 3 months at least. It's intensive. It costs money. Then anybody selling a company would be best advised to do some of that work up front.
Definitely.
So the share register, intellectual property, data protection, and so on and so on and so on, is doing that work up front can save a major embarrassment during the due diligence phase.
Yes, definitely. Time, money, and ultimately the deal.
Okay, thanks, Shaun. It's great.
Thanks, Justin.